Your home is not making you rich. I know how that sounds. I know you might have just felt a small defensive reaction to those 7 words, and I completely understand why. But stay with me for the next few minutes, because what I am going to walk you through today is one of the most important financial reframes most Americans ever encounter, and it is hiding in plain sight, built directly into the single largest financial commitment of your entire life. Picture this. You are in your early 40s. You bought your house about a decade ago. You have been making the mortgage payment every single month, reliable as clockwork. You have watched the property value climb. Your neighbors compliment you on your smart timing. Your parents are proud of you. You feel financially responsible, maybe even a little ahead of the game compared to your friends. And yet something does not quite add up. Your retirement account does not look the way you imagined it would by now. Your emergency fund feels thin. Your net worth on paper looks decent, mostly because of the house, but actual financial freedom still feels like something that happens to other people. You've been putting extra money toward the mortgage because that is what responsible homeowners do. And still, the finish line keeps moving further out. What if the thing you have been told is your greatest financial achievement is actually the reason your wealth is stalled? What if everything you were taught about home equity is backwards? That is not a rhetorical question. By the end of this video, you will understand exactly why and exactly what to do about it today. You have probably been told your whole life that buying a home is the smartest financial decision you can make, and the chorus of voices behind that message is enormous. Your parents, your grandparents, every financial magazine on the checkout counter, every home builder commercial on television, every well-meaning relative at Thanksgiving dinner. The American dream is not just a cultural metaphor. For most people in this country, it is literally a house with a yard, a paid-off mortgage, and the deep feeling that you have finally made it. The logic feels completely airtight on the surface. Renting is throwing money away, they say. At least when you pay a mortgage, you are building equity. You are investing in yourself. You own something real, something permanent, something no one can take from you as long as you keep making payments. And on the surface, that reasoning is not crazy. It comes from a generation that watched home values rise steadily through the post-war era and watched those who owned property accumulate more wealth than those who rented. The observation was real. The conclusion just got distorted over time. Here is where the conventional wisdom builds its case. The Federal Reserve's survey of consumer finances has consistently documented a wide wealth gap between homeowners and renters in America. The numbers show that the median homeowner builds significantly more wealth over time than the median renter. That gap is real, and it is large. So the message that homeownership builds wealth is not fiction. It is rooted in documented data, which is precisely what makes the illusion so convincing. And so the belief gets reinforced at every stage of your financial life. You get your first real job and start saving for a down payment, because that is what responsible adults do. You get married and buy a house, because that is the obvious next step. You get a raise and think about paying down the principal faster. You refinance when rates drop and shorten the term when you can afford to. You talk about building equity the way investors talk about building a portfolio, as though both activities produce equally powerful results. For millions of Americans, this is not just a financial decision, it is an identity. Being a homeowner means you arrived. It means you are grounded, stable, and serious about your future. The mortgage payment is not just a bill, it is a symbol of having your life together. That cultural weight is real, it runs deep, and it is exactly why the truth I am about to share is so difficult for most people to absorb the first time they hear it. But here is where the numbers start to tell a completely different story. If home equity is such a reliable and powerful wealth-building machine, why do so many American homeowners reach their 60s and discover that their financial security is almost entirely trapped inside a house they can barely afford to maintain? Why is the phrase house rich and cash poor so widely recognized that almost everyone in this audience knows someone it describes personally? Here is one number that stopped me cold when I first encountered it. Robert Shiller, the Yale economist who won the Nobel Prize for his work on asset prices, spent decades studying long-run American home price data going back more than 100 years. His research found that after adjusting for inflation, real American home prices appreciated at roughly 0.5% to 1% per year over that entire period, not 10%, not even 5%. Under 1% in inflation-adjusted terms, on average, across more than a century of American housing data. Now compare that to the long-run real return of a broad stock market index fund, historically approximately 7% per year after inflation. That is a difference of 6 to 7 times the wealth-building power. And yet the average middle-class American has placed their single largest financial bet on the historically weaker performing asset, usually without ever being shown that comparison side by side. If your home is supposed to be your most powerful financial tool, why does 100 years of data suggest it may be one of your least efficient ones? That question has an honest answer, and that answer is called the home equity illusion. So let us define exactly what that means, because precision matters here. The home equity illusion is the widespread belief that the equity you hold in your primary residence is a reliable, accessible, and high-performing financial asset, when in reality it is largely illiquid, expensive to access, historically weak as a long-term return generator, and dangerously concentrated in a way that most professional financial advisors would never recommend for any other asset class. Here is what this concept is not. It is not a claim that buying a home is always a mistake. It is not a claim that real estate is a poor investment under every circumstance. And it is not a claim that you should sell your house tomorrow. The home equity illusion is something more specific than any of those things. It is the trap of concentrating the majority of your investable wealth inside a single illiquid asset and calling that a complete wealth-building strategy. Think about this from a pure investment perspective. Imagine a financial advisor sat down across the table from you and proposed the following. You would put more than half of your entire net worth into a single investment that has returned under 1% per year after inflation historically. To access any of the money, you would need to pay tens of thousands of dollars in transaction costs. You could not liquidate it quickly without major financial penalties. And it could lose 30 to 40% of its value in a single economic downturn. Most people would get up and walk out of that meeting. But when that investment is their primary home, everyone nods and calls it the American dream. That is the illusion. Now let me show you exactly how intelligent, careful people fall directly into the center of it. The trap does not spring all at once. It closes slowly, one perfectly logical-sounding decision at a time. It begins at the purchase itself. You stretch a little more than you planned for the down payment. Maybe you redirect money you had earmarked for your retirement account because the house feels more concrete and more important right now. You tell yourself you will get back to investing once you are settled. The problem is that once you are settled, almost never arrives on schedule. That first redirection of dollars away from liquid investments and toward the house is step one in a process most people never realize has already started. Then comes the reality of the monthly payment. Property taxes, homeowners insurance, and the principal and interest combined turn out to be more than the simple mortgage number in your head. You are still contributing to your 401k, but only enough to capture the employer match, nothing more. You tell yourself you will increase the contribution after you adjust to the payment, after the kitchen gets finished, after the car loan is gone. That quiet trade-off is step two. Then the house needs work. Every house needs work, a great deal of it. Financial professionals commonly recommend that homeowners budget between 1 and 2% of their home's value every year for maintenance and repairs alone. On a home worth $350,000, that is $3,500 to $7,000 per year, money that evaporates year after year, silently, never appearing on anyone's home equity balance sheet and never building toward anything. That steady bleed of cash is step three. Then the value rises and something interesting happens in your brain. You feel wealthier. The number on Zillow feels like investment success. When you get a raise, upgrading the house feels natural and even smart. Because you are investing in a rising asset, right? You redo the bathrooms, add the deck, renovate the kitchen. Each decision feels connected to your financial strategy, But every dollar that funds those upgrades is a dollar that never builds liquid wealth. It feeds the illusion instead. That is step 4. By the time you pause and notice how much of your entire financial life is concentrated in those 4 walls, you are deep inside the trap. And you built it with one rational seeming decision at a time. Now let me show you the specific financial mechanics, the actual ways this overconcentration quietly works against your long-term wealth. The first mechanism is illiquidity. Home equity is not spendable money. It is theoretical. It sits on a balance sheet, but it cannot pay a bill or fund a retirement withdrawal. To actually access it, you have 3 realistic options. You can sell the house, which typically costs somewhere between 5 and 8% of the home's value in agent commissions and closing costs. On a $400,000 home, that is $20,000 to $32,000 just to get at what you supposedly own. You can take a home equity line of credit, which puts you back into debt at a variable interest rate against the very equity you spent years building. Or you can do a cash-out refinance, which resets your mortgage timeline and frequently increases your monthly payment. None of these options are free. None of them are simple. And not one of them resembles the ease of clicking withdraw in a brokerage account. The second mechanism is the invisible carrying cost. Every year you own a home, you pay a significant amount simply to hold your position. Property taxes across the United States average roughly 1.25% of assessed value annually, and in high-tax states like New Jersey or Illinois, that figure runs considerably higher. Homeowners insurance adds another 0.25%. Maintenance and repairs, the roof, the water heater, the HVAC, run 1 to 2% per year for an average home. Add those together, and you are spending somewhere between 2.5% and 4% of your home's value every single year just to maintain what you already own. That is not building wealth. That is the annual cost of occupancy. The third mechanism is opportunity cost. Every extra dollar applied to mortgage principal is a dollar that does not compound in the market. If you redirect $1,000 a month from extra mortgage payments on a 4% mortgage into a low-cost total market index fund, history suggests that money grows at roughly 7% per year after inflation. Over 20 years at that rate, $1,000 a month becomes approximately $490,000 in liquid investable wealth. The mortgage interest you save by paying down early is real, but it is not in the same category as what compounding in the market can produce. The fourth mechanism is concentration risk. When 60% or more of your net worth sits in a single asset, in a single city, in a single neighborhood, you have made an enormous, undiversified bet. The 2008 financial crisis illustrated exactly what that bet looks like when conditions shift. Median home prices fell roughly 30 to 35% nationally from peak to trough. In some metropolitan areas, the decline was far deeper. Millions of homeowners watched equity they had spent a decade building disappear within 24 months. Not because they made reckless decisions, but because they concentrated too much into one place. These 4 mechanisms do not operate in sequence. They work simultaneously, compounding against each other silently, year after year, while the rising number on your property app makes everything feel perfectly fine. The data behind this is not a fringe perspective from contrarian bloggers. It comes from some of the most credible research institutions in the financial world. Robert Shiller's work on long-run American housing data is perhaps the most cited finding in this conversation. His research, built on more than a century of price records, demonstrated that after accounting for inflation, real home appreciation has averaged somewhere between 0.5% and 1% annually. That finding challenged the foundational assumption that American real estate is a strong, reliable wealth builder in the same league as equities, and it has never been seriously refuted. The Federal Reserve's Survey of Consumer Finances provides a parallel data point. For the median American homeowner, primary residence equity typically represents the single largest component of total household net worth, frequently 40 to 60% or more of everything a family owns. That means the financial security of tens of millions of American families rests almost entirely on a single illiquid position. By any standard of portfolio construction, that is a dangerous concentration of risk regardless of how solid and permanent it feels. Research examining household financial outcomes across multiple economic cycles has consistently shown that families who directed surplus cash toward diversified index fund investments rather than accelerating mortgage payoff arrived at retirement with significantly higher liquid net worth and meaningfully greater financial flexibility than those who made extra mortgage principal payments their primary savings strategy. The dollars were identical. The direction of those dollars determined the outcome entirely. That last point deserves a moment of stillness. It is not about earning more. It is not about sacrifice or discipline. It is about understanding which direction your existing dollars should travel and making a deliberate, informed choice to send them somewhere that compounds freely and stays accessible when you need it. So here is what you actually do about this. Not in theory, in practice, starting this week. The first step is to stop treating your primary home as your primary retirement vehicle. This single reorientation is the most powerful shift in this entire framework. Your home is where you live. It may appreciate over time, but it is not your retirement plan. Your investment accounts are your retirement plan. The moment you establish that distinction clearly in your mind, every financial decision you face begins to organize itself more intelligently. The second step is to maximize your tax-advantaged retirement accounts before making any extra mortgage payments. The Internal Revenue Service, or IRS, currently allows individuals to contribute up to $23,000 per year to a 401k account and up to $7,000 annually to an individual retirement account. If you are 50 or older, catch-up contribution rules allow you to put in even more beyond those limits. Before one extra dollar touches your mortgage principal, these accounts should be fully funded. The combination of tax advantages and decades of compounding inside those accounts produces results that accelerated mortgage payoff simply cannot replicate. The third step is to audit your actual concentration right now. Pull out a piece of paper. Write down your estimated home equity, current market value minus what you owe. Then write down all liquid assets, retirement accounts, brokerage accounts, savings. Calculate what percentage of your total net worth is sitting inside your house. If that number is above 50%, you have a concentration issue that deserves a strategic plan, not panic, but a clear, deliberate intention to build liquid wealth alongside your home over the coming years. The fourth step is to redirect surplus cash flow toward liquid, diversified investments. If you have been making extra principal payments each month, redirect that exact amount into a brokerage account or a Roth individual retirement account invested in a low-cost total market index fund. You are not abandoning your home. You are building a second, liquid layer of wealth that does not require you to sell anything, borrow anything, or ask anyone's permission to access when retirement arrives. The fifth step is to be honest with yourself about renovation spending. Most home upgrades feel like investments. Industry research consistently shows that the majority of major home renovations return somewhere between 60 and 70 cents on the dollar at resale. A $40,000 kitchen renovation typically adds roughly $25,000 to your home's sale price. The other $15,000 is simply spent, not invested. Enjoying your home beautifully is a completely legitimate use of money. But labeling lifestyle spending as investment spending distorts your financial picture and keeps the illusion alive. Now let me show you what the alternative actually looks like in specific dollar terms. Take two households. Both earn a combined $90,000 a year. Both own a home worth $350,000 with a $200,000 mortgage balance remaining. Both have been redirecting an extra $500 per month toward their mortgage principal. The first household keeps doing this. In 15 years, their mortgage is gone. Their home equity may be $300,000 or more. But their investment accounts outside of retirement are thin, and their liquid net worth is limited. When they decide to retire, their primary financial tool is a house they need to sell, downsize, or borrow against simply to generate annual income. The second household changes course today. They take that same $500 a month and invest it in a low-cost index fund inside a Roth IRA and a taxable brokerage account. At a historical average return of 7% annually, $500 a month over 15 years grows to approximately $125,000 in liquid, accessible wealth. Money they can use without selling their home, without taking on new debt, and without asking a bank for permission. The second household's mortgage is not paid off quite as quickly, but they enter retirement with six figures in deployable assets, funds that generate income, fund opportunities, and provide the kind of real financial freedom that a paid-off house sitting in one neighborhood simply cannot provide on its own. Same income, same home. Same $500 a month, redirected toward wealth. Radically different financial freedom at the finish line. The home equity illusion is not about disliking your house. Your home provides genuine value. It offers stability, community, protection against rising rents, and a long-term store of value that should not be dismissed. None of that changes by understanding this concept more clearly. What changes is how you think about building wealth. The illusion, at its core, is this: believing that because your home is your largest and most visible asset, it must also be your most productive one. That confusion between size and performance is what keeps millions of Americans working longer than they need to, living in beautiful homes with thin retirement accounts, wondering quietly why financial freedom never quite arrived. You now understand something that most of the people around you have never examined. You can see the gap between the story the culture tells about home equity and the actual mechanics of how it functions across a lifetime. The single most important thing you can do today is open your retirement account. Find out exactly how much room you have remaining in this year's contribution limit and increase your monthly contribution, even by $50. That one act, done this week, starts building the liquid foundation your future actually needs, not instead of your home, alongside it. Your house is your home, but your financial future deserves more than one address.